If you are in the market to purchase a new or used skid steer, excavator, or piece of construction equipment, then this video is for you. If you're like most business owners, you are concerned with the interest rate you will pay to finance a piece of equipment. Did you know that you could be offered a great interest rate? However, there could be hidden gotchas in the contract that will cost you a lot of money. Unless you are buying a brand new piece of equipment through Caterpillar or John Deere, it is very unlikely that you will actually have a contract that's a principal and interest loan or a fully amortized loan. The four most common contracts that are available for used construction equipment like excavators, skid steers, or any other piece of construction equipment is an EFA, which we call in the industry an equipment finance agreement, a dollar buyout in which you make your payments, and then at the end of term, you send the lender $1 and they release the UCC, or if it's a titled piece of equipment, they release the lien on the title. Third type would be a purchase option lease agreement, and the fourth type would be a security agreement. Now here's where it can get a little tricky. Each lender and each contract has its own nuances. And these nuances, unless you're careful and you ask the right questions, can cost you a lot of money. For example, on an EFA or an equipment finance agreement, there are some lenders in their contract that will allow you to pay off early and give you a discount where you'll save money. And then there are other lenders where there is no discount, so really there's no benefit for you to pay off early. Dollar buyouts and security agreements are the exact same way, where some lenders will allow you to pay off early and some lenders won't. Now, if you're working with a finance company that is offering you a purchase option lease agreement or an FMV, which is what we call a fair market value option, you need to read the contract carefully. Why? Because in every lease agreement, specifically a purchase option lease agreement and a fair market value lease agreement, there is what's called a notice provision. Now, a notice provision is a set period of time in which you have to give the lender notice as to what you want to do. If you want to keep the equipment at the end of term, or if you want to give it back to them. Now, this is where the gotcha comes in. If you miss the notice period, that lease will automatically renew for a set period of time. For example, let's say you have a 60-day notice provision. That means before 60 days at the end of the agreement, so 60 days prior to the agreement ending, you have to let in writing the lender know if you want to buy the equipment or own it. Now, if you happen to miss that notice period, let's say of 60 days, it is written in the lease agreement that your lease will automatically renew for a set period of time. In this instance, let's say 6 months. So you've missed your 60-day notice period. Now your lease has extended another 6 months. That is what we call the evergreen clause. The evergreen clause is written into a lease contract as a way for that particular lender to make more money. Now, be very careful because in the notice provision period of that 6 months, you will also be required to give a 60-day notice. If you miss that 60-day notice on the renewal period, your lease will renew again for another 6 months. Now, I'm sure you're starting to figure out why they call it the evergreen, because honestly, it's really raining your green money for that particular lender. So the next time you are offered a really good interest rate that could possibly be too good to be true, make sure you find out what type of contract you're signing, and if it is a lease, be sure to ask the questions and read the contract. Now, if you have any questions about equipment financing or would like us to read over a contract for you because you're not quite sure of what the legal term means in it, we are more than happy to do that. Just give us a call or click the link below.